In this episode, we speak with Mo Al Adham, founder and CEO of Frec, a company transforming complex financial products that have traditionally only been available through wealth advisors into automated, easy-to-use technology. Mo's team has been funded by a long list of notable investors, including Google, Meta, Brex, and others, with their biggest backer being Greylock. Frec's goal is for customers to reach financial independence. With modern-day technology, financial control is shifting to the hands of everyday investors. Frec exists to enable that shift and give everyone the chance to create new opportunities for their wealth. I'm your host, RJ Lumba. We hope you enjoy the show. If you like the episode, click to follow. Mo, great to chat with you. Thanks for taking the time.
Yeah, of course. Thanks for having me. I'm excited.
So the area of fintech platforms and making accessible products that aren't typically accessible to the broader population, that's a theme that's been happening for some time. We've had on the podcast others that are in this space. Tell us about Frec and what differentiates you from the others out there.
Yeah, totally. So yeah, like what Frec is doing is basically exactly what you described. We're giving access to everyone for this strategy called direct indexing. And it's quite an awesome product strategy because what it does is it essentially on days like today, we're recording this podcast on April 3rd after Trump has announced the tariffs, right? And the market is quite red today. The S&P is down 4%. And we're trading a lot. So what we do is we give our investors the ability to track the index, just like you would if you bought an ETF, but the additional perk of harvesting capital losses. So when markets are moving, we're able to trade, sell stocks that are trading below their cost basis, and buy other ones, and basically give you both the market returns of the index fund that you like and the cap losses that you can use to offset capital gains from other parts of your portfolio. And the last thing I'd say about this is sort of like a strategy that's been used for decades now by very large family offices. And you needed a lot of money to enter into the strategy, and you needed to use some very specialized custodians and providers. And so what we did is we just wrapped it around a product that is self-serve and that's easy for anyone to use.
Excellent. So when you talk about tax efficiencies in that general topic and strategy, is it that on your team you have some of that expertise, or it's simply you're like the conduit to others that do that on behalf of typically wealthier clients, but now you're making it accessible to others?
So we built this as an end-to-end product, as a vertically integrated product. So you come in, you bring your assets, whether they're stocks or they're cash, you select your index. We've licensed all the indices directly from the S&P, from CRSP, from Russell, and we do everything. We do the trading for you. We're also like custody your assets with a clearing firm. And so all you need is basically to create an account on Frec, a normal brokerage account, sort of like sign up flow, and then the assets, and then that's it. You don't need anyone in the middle. You don't need a wealth advisor to help you manage that. The experience is quite self-serve.
And you have a very interesting background. This is your third company, I believe. What do you spend most of your time focused on?
Today is very different from the first company, for sure. It's a lot of it is on trying to find the right people to join the team and helping shape the product, and also giving feedback and sometimes, editing the team, if you will. And so a lot of it is that. And yeah, it's really important because obviously, the team comes first. And then if you have a great team, then they build a great product. And if you have a great product, then the revenue follows. And you can't skip steps, right? You kind of need to operate in this order.
And is that different than your first go around? Like, what did you focus on with your first startup?
I think I was focused on coding back then and building myself. And, I was very young and I was doing something right out of school. And, that's not scalable.
Mm-hmm. You've managed to attract like some of the best investors out there. You've got Greylock as one of your biggest backers. You've got Google and Meta. Tell us about maybe those relationships and the value that kind of partnering with those types of people brings to you aside from the financial capital.
So yeah, VCs, venture capitalists, obviously the number one thing they would give you is the capital, but also beyond that, right? Like the network, the relationships, the fact that they just sit on your board and help, I guess, either validate your strategy or question it and help you refine it. There's a massive amount of value in that, right? Like just having you stay maybe more focused or avoid like a mistake or help get the right partner or close a candidate, right? And so there's a ton of value there. The top VCs are very good at that. And so I like working with Greylock a lot. They've been fantastic. And, beyond just the partner himself on the board, there's also like a suite of other services. Like if you need to recruit someone very specialized, you have a team, if you're launching a product, there's a marketing person who helps you draft a press release and get it in front of the right people and so on. So it's not just, the partner. And then, we raise money from a lot of angel investors, and those angel investors who work at Meta and Google, like you mentioned, they're fantastic in that, in terms of just product feedback and opening up their networks for introductions or general help.
And, the way when I was kind of going through your site, what was coming out to me was like, oh, this is the lowest cost provider. But that's kind of like simplifying it too much. Like, you're not just a low cost provider. You're also, there's a lot more to your product. There's a lot more in the way that you're trying to kind of stand out in the market. So maybe for the benefit of our audience, what's the easiest way to think about why they should, if they were to choose a platform, why they should choose you?
Yeah, totally. So direct indexing in general, if you want to go down the path of optimizing not just for fees, but also for tax efficiency, then you want to choose this product category. Like sometimes people call it an SMA or some like tax advantage, or it's like tax aware investment strategy, right? And, it turns out that actually fees play a big part in that, right? Because if you pay a lot to save money on taxes, then eventually you're paying that additional cost for a long, long time if you're a long-term investor, and you don't want those fees to basically outweigh the tax savings. It's kind of counterproductive at that point, right? And so I do believe that cost is a big factor in this, and the only reason we're low cost is because the other providers charge egregious amounts of money that are not justifiable. That's relative to them, we're low cost, but I think we're actually priced correctly for this product. And if you're paying 3 basis points to own a Vanguard ETF, and then you're considering paying 50 basis points, 47 more basis points to own some tax advantaged equivalent product to that ETF, then you have to do the math. Well, is that worth it? Is the 47 extra basis points worth it for these tax savings? And maybe it is for the next 3 years, but in 15 years, as your portfolio compounds, it's not, right? And that is kind of the key thing, is like we believe we price a product correctly for the long-term investor, folks who want to hold their assets with us for 10, 20, 30 years plus, and they're still winning with their tax savings. And so, the analogy that I like to use is imagine credit cards launched, priced incorrectly as well. Like imagine every time you had to swipe your card, you had to pay 5% in extra fees to the merchant. Like, the adoption would be low. And that's kind of what was happening with this product. It was priced too high. And by the way, if you had access though, if you had a great wealth manager that had access or pooled you with some other very wealthy families, you got the 10 basis points price point. But if you didn't have access and you just walk in off the street to a parametric or something like that, you're paying 50, 60, 70 bips. That was the issue with it.
Mm-hmm. And are you primarily focused on this one solution? We've had folks on who say it's actually key for us to have a lot of different products, a lot of different asset classes, because that way we can retain these customers and appeal to them, across whether it's you having alternatives access, fixed income, equity, et cetera. And then we've had others that say, no, our focus is on one product. Like if you want fixed income, you come to us. What's your view on that?
Yeah, I'm definitely in the camp of the latter. Like, I think, our customers are sort of like, I call them best of breeders. Like, they will find the absolute best place to put money in a high yield account, checking account. Then they'll go and find another product that is like an excellent donor advised fund that's unmatched with its capabilities. And then, they'll find a fixed income provider, and then hopefully they choose us when they want to put money into a tax advantage account that's generating both savings for them as well as tracking the performance of their favorite index, right? And so that is sort of like the way we see it. And it is quite a difficult product to get right as well. And so if we were trying to do too many things, the quality of our work would be lower and just our customers would not be as delighted, and they wouldn't talk about it to their friends, right? And so at least our philosophy for now is to stay focused, do one thing extremely well, and basically delight the customers and have them become our marketing engine in a way.
And did you know from the very beginning that this would be your product, or did you iterate to get to this product?
We knew fairly early on that this was going to be it. Yeah. And we actually kind of spent a long time getting it right before launching. So we launched in October 23, but we spent a year and a half before that building the product. It was quite expensive because you had to become a broker dealer, you had to become an advisor, you had to build the core capability to get the experience we wanted. We had to do it fully vertical, right? Like you had to like bring the assets in, do the ACAT transfers and deploy the and so on. And so it took a while, but we had conviction. We
Mhm.
were sure because we did our research. We talked to many customers and we knew this was a big need. And so it wasn't a thing where we're like, oh, let's do an MVP and launch it and see how it goes. It wasn't one of those experiments.
Interesting. And did your kind of background in forming other companies, did that inform how you approached it, like not doing the MVP and doing more heavy research?
Yeah, totally. So the first company was the exact opposite. It was very much let me build something very sort of like minimalistic, put it out there and see if people click, and then I'll build the thing that people click on. And my learning was this doesn't really work very well. Maybe in this product category, I should say, where
Hmm.
people are putting in money, they're trusting you with millions of dollars in some cases, and they expect performance, and you can't really drop a beat. You have to be on top of it. And so we had to like build quite a complete product that functions well. And then the other kind of thing that played into it is I spent 6 months researching this company before starting it in the first place. So I sort of like learned from the first ones is that your choice of market and your choice of product is going to be the number one determinant of your success or failure. And so you want to make the right call. And so would you be able to make the right call in 3 weeks? I thought maybe not, because the company is going to take 10 years to build. So a 3 week research project to figure out the idea wasn't going to be enough. It needs to be like a 5% of the amount of time you have allotted for this company. And so that to me was 6 months. So I spent 6 months talking to people. And so, I kind of came out of this with extreme conviction that this
Hmm.
would work.
And who were the right people to talk to? Was it prospective customers was it people already working in the industry?
Yeah, it's a combination. It's funny you mentioned the Meta and the Google investors. A lot of them were people I interviewed to understand their needs and what was lacking in their current solutions. And we ended up actually, our seed round was 75 of these customers I was interviewing that ended up writing a check for us. And then Greylock came in and wanted a piece of the seed round as well, and some other investors like Social Leverage. But yeah, they turned from people who I interviewed just to learn through my network really, and sometimes random reaching out to folks on LinkedIn. They became investors in the company and continue to give feedback afterwards.
How easy is it to sign up?
On Frac today,
Yeah.
oh, it's just like you'd open an account on any brokerage on a Fidelity or Vanguard. You can just as quickly do that on Frac. And then as long as you have the intention to invest in the market and you know what you want to invest in. So unlike other robo advisors, we don't tell you like, oh, you're like a 7 out of 10 risk appetite, and then this is what you should buy. We don't do that piece. We kind of know our customers are maybe slightly more opinionated than that, and they know they want the S&P 500 or they want a small cap index or an international, and they know the proportions and everything. So as long as you know these pieces, then it's very easy to get started.
Is it as easy as saying like if you're investing in the S&P 500 and ETF on Merrill Edge or one of these standard platforms and you plan on just leaving it there for a while, you're better off parking it with Frec because you're going to save on taxes. Is it as easy as saying that?
This is the exact pitch. You nailed it.
Okay. And
Yeah.
so what's the ramp like? How's the adoption been?
Very good. Yeah, it's been so we went from zero assets on Frac to 200 million in less than a year and a half. And it's been obviously the growth has been accelerating. So our growth rate has stayed, high, but despite the denominator growing. And, if you kind of take that sort of like ramp and you compare it to like how did Robinhood grow early on, or how did M1 or how did Wealthfront or Betterment, in many cases, we beat what those early numbers look like for these other players. So we're quite happy. And I should also say we've done all of this without a marketing budget. So basically, we educated some early people on exactly what you just said, and they used it. They saw that it actually works that way. They saved money on taxes when 2024 tax season came up. And then they told their friends about it. And now we have clusters of customers from Meta, from Google, from Amazon, a lot of tech folks. We have doctors, we have nurses, we've got finance folks who use it, like it, and kind of spread the word about it to their friends.
Now, the one thing that comes to mind, maybe like the consideration to moving money to Frac might be Is it less flexibility? Like if you move your money to Frec, you want to know that you're not gonna need to buy and sell frequently.
Yeah, definitely. So this is kind of your bucket of money that is really, really long-term money. And a lot of our customers, like we also end up attracting folks who have gotten their big purchases out of the way. Maybe they've already like paid for the wedding and purchased the primary residence, and now they have excess income, right? And they're like, okay, well, I usually invest in a Vanguard ETF. I have a Vanguard account, and I'm putting my money in VOO, the VTI. And the pitch is like, hey, this is great. You should continue doing what you're doing, but change the format from an ETF to a direct index and get these tax savings. Yeah, so that's how it ends up happening.
So on your team, do you also have folks that are in finance that have the finance expertise to execute on the strategy? That's not outsourced, it's in-house.
Yeah, everything's in-house. We've got licensed professionals here. We've got quant engineers. Obviously, it's an optimization problem, right? When we're trying to figure out, like on a day like today, what should we buy? What should we sell? So we're tracking the index and we're getting you the maximum cap losses. What are the tax lots we should trade today? And so that's an optimization problem that we built. And, we license some pieces of software, like the risk model, like the covariant matrix, right? That tells us if you sell Tesla, here are the 7 stocks you should buy instead. That would help you track kind of the same performance. And there's some very sophisticated risk models that are used by hedge funds globally that we also license. And so, yeah, there's pieces that are built in-house. There's pieces that are licensed, but most of it is in-house.
And is there an additional kind of yield that you can generate? Or do you just simply say, we are going to match the S&P, but you'll see a slight uptick because of the tax efficiencies? Or can you generate even more yield from that?
So there are a lot of opportunities. Our quant team is very excited about these things, and they're like, "Oh, there's this alpha here," but we're kind of just like very focused on let's really nail the tax efficiency piece because that could be substantial. Like we're talking about somewhere between 1.4% to 3.5% in additional market returns every year for investors. And that is sort of like, besides tracking error, which is kind of a managed problem at this point, there's not real risk beyond that. And so, yeah, that's quite a bit, over like a 10, 20, 30-year period that can add up.
That's incredible. I got to imagine that your retention rate is extremely high. I mean, it has to be, I guess, by the
Yeah.
nature of your solution.
Totally. Funny you say that because, yeah, our churn rate is just incredibly low. People don't leave because, I mean, once they see the tax savings and also just the nature of the product, if you exit the strategy, you have to find another direct indexing provider that can absorb your 500 stocks to like basically tax loss harvest them and manage them for you. And, there aren't many out there that offer the self-serve nature and the low cost that we offer. And so, yeah, most of the churn that we've seen, and it's like extremely low single digit, like maybe 1 or 2% from the folks who signed up like a year and a half ago. We lose them because, for example, oh, I decided to go with a wealth manager. Money to my family is overwhelming. So I've decided to kind of switch to a wealth manager. And those are the folks that we end up losing.
Got it. We're heading into the tail end of the conversation. I do have one question before my last two, which would be, having been around the block, a few times in terms of building companies, what advice would you give to another entrepreneur? And I guess it could be an entrepreneur at any stage of their company building process.
Yeah. So I guess like there's quite a few learnings from those companies that I started, but I would say the most important one and the most I think I feel from the entrepreneurs that I talk to underappreciated is like the importance of grit and sticking to the direction and to the strategy that you hopefully have studied very well before embarking on it. And we're very emotional beings, right? And so market movements, or you get like one client who leaves one day, or you win one big deal and you get like ecstatic or sad, whatever. These don't really matter, like as long as in the long term you're executing on a strategy that is well studied and well vetted and well understood, and just stick to it. Building a company takes a long time. It takes at least a decade. It's not 4 years. I don't know why vesting schedules are 4 years, but it's at least 10 years, right? To build a company.
Well, it seems like on this company, it's been pretty smooth in terms of your ramp up and to the right. Has it been that way? Were there times where you were, maybe discouraged or maybe you were enticed by another shiny object that you were like, oh, maybe we should go in this other direction? Or has this one just been like a lot smoother?
Oh, absolutely. There's been a lot of shiny objects along the way. Like there was a time when SVB and First Republic kind of they had those problems, and all the rage was on money market funds and high yield accounts. And we had these companies with large deposits and say, like, hey, we'd move everything to Frec if you build this and that, a treasury product. And we thought deeply about it. And, we kind of tried it for a minute. We made the mistake of trying it for a couple of weeks. And then we're like, wait a second, what are we doing here? Like, this is not a strategy. There's better equipped companies that do this, right? Mercury is out there, like Ramp is out there, there's others. And so, everyone falls prey to these ideas and these temptations, but don't spend too long making the mistake. Like recognize when you're going down the wrong path and like pull back into your core thing.
Right. Excellent. Last two questions. One is, can you tell us about a person who has had a profound influence on you?
So this may sound very cliche, but for me, it was my parents, both of them. My mom is a chemist, my dad is an engineer, and they were ever since I was a kid really encouraging of me to be a truth seeker, to just understand the world and admit when I'm wrong, and just like not sort of like try to pull myself back when I'm making a mistake. And so I'm still very close to both of them right now. And yeah, I hope I can do the same job they did raising me and my siblings to my own children.
Awesome. Last question. Can you tell us about a charity cause or other endeavor that you're passionate about?
Yeah, that's funny because I chose to build this company because of that same, I guess, cause that I'm passionate about, which is I would like to contribute to making society such that everyone's like free to do the things they really want to do without having the financial burdens that slow us down in life, right? And if we can help people do that through saving them a little bit of money here or there or optimizing their wealth a little bit more, I think that's a big win for humanity. And yeah, that's why sort of like I'm building Frec is to help accomplish that like sort of like bigger mission and bigger goal.
Fantastic. Well, Mo, I want to thank you again for taking the time. This has been a wonderful conversation.
Awesome. Thank you. I appreciate having you.